All right. Hope everybody's having a good summer so far. My name is Brandon Hall. I am the founder of the Real Estate CPA, and just wanted to thank everybody quickly for signing on to today's webinar. I think it's going to be really good. It's going to help a lot of people understand life insurance. It's a question we always get from our clients, and we're always like, hey, you got to talk to a financial advisor. So now we have two of them as guests. Before I introduce our guests, just want to quickly say that if you are interested in our services, tax services, accounting services, head to the realestateCPA.com, fill out a web form, and we will be in touch to discuss. Can everybody raise their hand if you can hear me? You can raise your hand on the Zoom panel, or we got some people figuring it out. All right, good. At least half of the people can hear us, so that's good. All right, I'm going to lower everybody's hands. Thank you very much. Some other quick housekeeping items. Your chat has been disabled, so you can't chat with the attendees, you can't chat with other attendees. You also can't chat with the panelists. If you have any questions, you're going to need to use that Q&A button at the, I think it's at the bottom. It might be at the top for attendees, but there's a Q&A button on your screen somewhere. You can use that to ask questions. Make sure that when you ask a question, if you don't want people to know that it's you asking the question, that you ask anonymously. Otherwise, everybody's going to be able to see your name when you ask that question. Your questions may not be answered with the time that we have. So if you do have leftover questions, or if your question wasn't answered, go ahead and send them to contact@therealestatecpa.com, and I'll throw that in the chat in a second. And we'll make sure that we get your questions over to Felix and Taylor. And questions and answers will not be retained and distributed post-call. That's a limitation of Zoom, unfortunately. So take good notes and be attentive. This webinar is going to be recorded, and it will be sent out post-call via the newsletter that you guys all received to sign up for this webinar. So just be on the lookout for that. And we've also got, I'm about to send out the webinar from Brian Eastman last week on solo 401ks and self-directed IRAs. So I'll probably just send out both of these together a little later on this week. So just be on the lookout for that. All right, our guests, Felix Tuccillo and Taylor Patterson. They're both financial advisors at Northwestern Mutual. They advise in a lot of different financial products. They have a lot of different certifications. Both of them are very smart. We've been interacting for a while now. Today, they're going to be talking about life insurance and how you can use it to further your real estate investing. So it should be a really good presentation. I'm attending this one personally because I want to learn too. So I hope everybody enjoys. But Felix, Taylor, you guys have the floor. Take it away. And like I said, I'll be in the background. So if you need me, just pause and shout.
All right, sounds good. Perfect. Thanks, Brandon. All right, everyone, good afternoon. I'm going to get this going right now. All right. So, as Brandon said, my name's Felix. This is Taylor right next to me. We're with Northwestern Mutual out of Bucks County. I'm Bucks County, Pennsylvania. Taylor's in our Hunterdon, New Jersey office. And been with the firm for 9 years. Taylor's been with the firm for about 4. And today what we want to do is have a chance to share with you a little bit about how you can utilize life insurance and how it's more than just a death benefit. Hopefully at the end of the day, everybody can take a little nugget or two away from our presentation. And if you're interested, we're going to put our contact information up during the Q&A session, so you can reach on out to us separately if you'd like to. So again, like Brandon said, if you have any questions, put them in that Q&A space. And then once we're wrapped up here, we'll go ahead and get to them and address as many as we can in the time we're allotted. So, all right. So hopefully everybody on this call has some sort of life insurance in place. But what we want to do today, our agenda, if you will, is to talk about the different types of life insurance and how they work, how life insurance can help you achieve financial security by being the cornerstone or the bedrock, if you will, of your financial plan, and more importantly, how to assess which type of insurance best fits your needs. So the two types of life insurance, as most people know, are term insurance and permanent. Now, term insurance is very standard in the industry. Permanent comes in a lot of different varieties. It's also known as whole life, cash value, universal life, variable universal life. So they're all interchangeable, but they are permanent in a sense in that they have no expiration. So how the life insurance plans work, Term insurance is a finite amount of years. So for instance, you buy something and you buy a duration of years, say 20 or 30 years. And at the end of that 20 or 30 years, if you're still alive, the good news is you're still alive. The bad news is that insurance and that death benefit goes away. So in essence, it's a use it or lose it type vehicle, unless you choose to renew it at rates that are set by the company. So in your world, similar to property, it's similar to renting a space, renting an apartment, in that the payment is lower. However, at the end of the day, there's no rights of or incidents of ownership. So therefore, there's no equity that's returned to you, maybe outside of a security deposit. From a cost, it is the cheapest and most affordable of all the insurances that are available. So generally, we're talking about term insurance to our clients that are younger, just starting their careers out, bought a home, starting a family, getting married, and things like that. In the permanent space, again, permanent means no expiration, right? So perpetuity. So you buy a policy and it affords you coverage for your whole life, assuming that you pay the premiums or you take advantage of certain options which are called paid up. So what happens with a whole life policy, similar to owning a piece of property, you have the market value of a home or a piece of property, and that's the death benefit that you buy. And when you buy a death benefit, the death benefit is stated at a certain dollar amount and is guaranteed not to go any lower. At the same side, you have a cash value component similar to equity in a piece of property. So that equity over the years builds tax deferred outside of the stock market. And similar to equity in a piece of property, you can tap into that equity up to 90% tax free. So what happens when you tap into that equity, you're borrowing against the death benefit of the policy completely tax free. And as a mortgage payment goes, those payments are higher than a traditional term policy, which is similar to renting. So we're going to quick watch a 2-minute, hopefully the audio here, Brandon, maybe will work. Quick 2.5-minute video put up by Northwestern. And if anybody has any issues, just let us know.
When you think about protecting the people you love, life insurance is one.
I'm not seeing a video playing.
Nothing?
Yeah.
You are, aren't?
I'm not.
All right. So let's see here.
Can you just explain what was in the video instead?
Yeah, that works. All right. So let's go back. So essentially, it was talking about I'll do this, get back. There we go. All right. So essentially, the living benefits of life insurance, as we mentioned, a lot of times when our clients purchase life insurance, you're buying a death benefit. However, the living benefits, if you will, we compare it to a Swiss Army knife. So you have access to the cash value at any point in time to be used as leverage. So we can use that and leverage against future real estate purchases instead of going out and possibly taking a second loan or mortgaging other properties that you own, and then pay yourself back with quote unquote injections, if you will, and paying that cash value back. You can use it if you have any children as a means of education planning. The unique benefit of cash value and life insurance is that when clients fill out the financial aid forms, you do not have to disclose the amount of cash value you have inside of your life insurance. So therefore, it's an excludable asset on a FAFSA form, but you can tap into the cash for education planning if you'd like to. The other way people do it, again, is supplemental retirement. So what we do at Northwestern in regards to retirement planning is giving you options and choices. That's really what financial planning is about. So if in a year in which the market were to have a downturn similar to 2009, what we're able to do is we're able to tap into the cash value, so that way we don't have to sell off our assets and our other portfolios at a loss to generate the amount of income you and your family needs to maintain the lifestyle. So that was a quick summary of what that video was. I can probably email the link to Brandon, and maybe he can get that out to you as well if you're interested in seeing it. So last year, LIMRA, which is the Life Insurance Market Research Association, put out a study, and the top reasons that Americans own life insurance, the primary reason is to cover final expenses, right? The purpose of insuring somebody's death. Followed second by replacing lost wages or income, which I feel is a very easily overlooked area when planning for insurance. Followed closely by transferring wealth or estate or legacy planning or estate enhancement, if you will, because death benefits are the unique feature of them are paid income tax free to beneficiaries. 54% was to help pay off mortgages. 52% was to supplement those retirement dollars. Pay for home expenses, so to maintain the family's lifestyle, followed at 48. 46% for estate taxes and estate liquidity. So that's a big thing here with our clients that are in rentals and real estate and the brick and mortar, in that properties may or may not be as liquid to generate those tax dollars that are due. So life insurance turns pennies into dollars at the right time to give your estate that liquidity it needs to pay the government within 9 months. And then 40% was due to tax advantage ways to save and invest, right? That's the benefit of also life insurance, in that the cash value grows tax deferred, but there's no contribution limit. So it works as similar to, say, a Roth IRA from funded with after-tax dollars. Tax deferred growth can access the money's tax-free, but there's not that cap on $5,500 or $6,500 a year with a Roth, nor is there any income limit. So a quick example here, and then Taylor and I actually ran something given the demographics of what Brandon told us might be on the call today. So if you had a 25-year-old male who bought a $100,000 permanent policy, 1977, so we're going back about 40, 41 years. The premium for that plan was $1,600. The dividends on that, so it's important when dealing with life insurance, there are two different types of insurance companies. There are stock insurance companies, that's the Prudentials of the world. And at the end of the day, Prudential is obligated more so to pay dividends to their stockholders, and then the policyholders come second. Mutually owned companies, which is our company, Northwestern Mutual, New York Life, Mass Mutual, Guardian, our policyholders own a piece of the company. So therefore, the dividends go directly back to our clients and are reinvested into their contracts. So if we took a look at that over a 40-year period, in 1977, we had a death benefit of $100,000. And over that 40 years, that death benefit now has appreciated to $514,000 and a cash value, which is similar to, again, the home equity, of $315,000. So we have two separate components, and we're able to tap into that $315,000, 90% tax-free, and that reduces the death benefit dollar for dollar. So what we did here is we ran an actual illustration just to show you what numbers look like today. All right. So what we assumed here is and again, these products are scalable and sizable. So it's not a one-size-fits-all when we plan with our clients. We don't do any cookie-cutter type planning. If we're meeting with a 40-year-old client, we're not going to assume he or she should be doing the same thing our other 40-year-old clients are doing. We cater to their needs. But what we wanted to do here is we assumed, what if we put $50,000 a year into a permanent plan? So at the top left-hand corner, for a 40-year-old, we ran for a 40-year-old male, best health class non-smoker. That $50,000 a year premium would buy you about $1.57 million of death benefit. So with whole life insurance, your cost or your contribution is fixed based off the age of which you purchase it. So you can see in this column right here, column number 3, that $50,000 is fixed. What's unique about whole life, it appreciates right off the get-go. So it is not a stable benefit, it is appreciating benefit. So that $1.56 million initially after year 1 goes to 1.57. Then we're at 1.67, 1.76, so on and so forth. Also, we're earning that dividend. And that dividend is something, it's comprised of expenses, expense management with a company, how well companies underwrite their applicants and their clients, and then the portfolio of the monies in which the company invests. So recently, in light of the 2009 economy and the low interest rate environment, which was persistently low for so long, Our dividend right now is at 4.9%. So these assumptions here assume our dividend over the next X amount of years does not change off the 4.9%. Now, the unique thing about a whole life policy is that there is positive correlation to the interest rate environment. So it's similar to a bond in that it is a safe vehicle, no volatility, but it differs from a bond in that in an appreciating interest rate environment, as we're seeing the government start to uptick those rates, our dividend is also going to uptick. So for instance, in 1988 and 89, mortgages were in that 18% range. We were paying an 11% dividend. So we expect our dividend to start ticking upward off of that 4.9. It's not on the coattails of the government, but it's about maybe a 2 to 3 year lag. So these assume conservative net assumptions. So what Taylor and I did here is, if we look here and we fund this, the way we designed the policy is we designed it so that we fund it for 22 years. We put in $50,000 over a 22-year period. That gives us a total contribution of $1.1 million. So we take $1.1 million, be it cash, be it other investments, rental incomes, whatever it be, and we redirect those dollars. And by redirecting those dollars, that now gives us a tax-free death benefit of approximately $3.7 million. If we gross that up, you're probably looking in the ballpark of about 4.5. And a cash value or an equity piece of about $1.58 million. So if you were to say after 22 years, you know what, guys, this was great, we're going to walk away, you will be taxed on the difference between column 6 and column 7. So you'll have a taxable event of about $483. On the flip side, $483,000. On the flip side, if we didn't touch that money and we let it ride, right? So we put no money into this for the rest of your life. And then at some point you decide, okay, we did this long enough. I want to start taking money out for myself and my family and my own retirement. So now what we did is we assumed we would take out $10,000 a month, tax-free, for a 15-year period. So we put in $1.1 million over 22 years. We then take out $1.8 million over a 15-year period. So from age 75 to age 90. And at that end of that 90 years, you're still left with a death benefit of $2.53 million, which can go to legacy planning, estate taxes, whatever it be. And you still have a cash value component of $2.11 million. So we put in $1.1 million. You've taken out 1.8. We're left with another 2.1. So for that $1.1 million contribution, we have about $4 million of cash in which we have access to. So it's a pretty cool concept when dealt in the right space. The other idea that which Taylor and I, the way we design it, is you can do a concept in which it's called overfunding. And that's how we did this. So when you look at life insurance, your premium goes towards two things. Your premium goes towards the cost of the insurance and the underlying cash. So generally, advisors out there sell it the traditional way. However, when we're dealing with the higher net worth market, we're going to structure the policy geared towards the cash. So out of that $50,000 contribution, up here in these parentheses, it says $25,000 of additional premiums. What that means is only $25,000 is actually going towards the insurance contract. The extra $25,000 we're dumping into the cash value and the general account of Northwestern, which is right now paying 4.9%. What that gives you as the client is flexibility. If there's a year in which cash is tight, something happened personally, whatever it be, we can take $25,000 off the table, take those chips back, no questions asked. And then in the next 2 years, you can bump it back up to full capacity. So when we design our plans, it's all about giving you options, giving you flexibility, having that liquidity, having accessibility when needed, all while not breaking the bank, okay? So before we get to the term idea, which is rather much more simple, again, keep in mind, Brandon said it earlier, that use that Q&A space. I know we're going over some things here. There's a lot of numbers on these pieces of paper. We can pull them up if there's other questions to reference. But if anyone has any questions, type them in that Q&A space, and we can go ahead and get back to this at that time. So if we look at the opposite, the term component, which is similar to renting. So what we did here is we went ahead and we ran the same amount of death benefit. So we ran a $1.5 million 20-year term plan. So for, again, a 40-year-old male, best health class, non-smoker, the cost for $1.5 million cost $117 a month, roughly $1,400 a year, right? So now we can pay $1,400 a year to insure $1.5 million tax-free versus $50,000 a year. The trade-offs are that the death benefit remains flat. So we know how far $1.5 million can go today. However, 10, 15, 20 years down the road, that value due to opportunity cost will be, that amount will be devalued. So it's a level death benefit. The premium is also fixed based off the age of which you do it. So as with any type of insurance, it's to your advantage to purchase insurance at a younger age because the cost of the insurance is cheaper and you have a longer life expectancy. It works opposite of car insurance. The younger people are, they're more of a risk, so therefore the premiums are higher. So at any point in time, if you were to decide to cancel this contract, there is no equity that builds up. So it is a pure insurance plan in that, again, you use it or you lose it, but it turns pennies into dollars and is the most affordable plan that's out there. At any point in time, you can cancel it, and we always go over these points in which you can consider. So the term is in force for the 20 years, as long as you pay for it. If you stop paying for it, you're not married to it for 20 years, you can stop paying on it, and it just goes away. But if you paid on it for 20 years, you've paid into it $27,180 over that 20-year period. And that was your cost to insure the $1.5 million. You have the ability, in point number 2 down here, you have the ability to convert this policy over to a whole life policy. So that's the other unique thing about Northwestern Mutual and some of the carriers out there. They will allow you to convert a permanent or a term policy over to a permanent policy in a certain amount of years without having to prove your insurability. So you apply for life insurance, you secure life insurance at a young, healthy age, and they allow you to convert that policy at the best health class, regardless of any health changes, for a certain amount of years. So with a 20-year term plan, it's convertible for the first 10 years. Another unique thing about it here is point 3, is that it self-completes. And self-completion is the same whether it's a term policy or a whole life policy. And what we mean by that is if anyone were to become sick or injured, disabled, whatever it be, for a period beyond 6 months, Northwestern Mutual picks up the tab. So therefore, they will pay the premiums for as long as you are unable to do your job. And then the last point here, as with the whole life policy, is all premiums are fully guaranteed, right? So that's important. So not at any point in time can Northwestern Mutual, or any company for that matter, come back and charge you more money in this particular case, more than $1,359 a year for this particular plan, okay? All right. So when we look at, again, going back here, with the overall financial planning or security, the way we work at Northwestern is we are not product driven as much as we are process driven. So when we meet with our clients, we first identify what your goals and objectives are. Again, no cookie cutter plans. We want to separate our clients from one another. What we then do is we take that information, and the better the input, the better the output, and we create a personalized plan or a financial roadmap. And that roadmap might consist of insurance and investments, okay? We build those plans out, we present those plans, and hopefully individuals implement them. If they choose to implement with us, then we meet with our clients minimally on an annual basis, because we feel it's important, even if it's just simple insurance planning, that you should review and check in on your insurance plan at least once a year, just like we should go to the doctor once a year and get an annual physical. So when you deal with that risk management sector, it's giving you that safety net. If something happens, if a wrench gets thrown into your plan, it protects your ability to continue to reach those goals that you set out if you're healthy, you're working, or more importantly, if you're even still here. Wealth accumulation. We talked about how the cash value inside of a whole life policy grows steadily over time. So that money grows guaranteed. So it will be the only asset in which you will ever own in a portfolio that is guaranteed to grow over time. So what happens is when you establish actual values inside of your contract, that value, say for instance this year, if we go back and we look at, actually it might be easier, if we go back and we look at this illustration here, and in 10 years, now again, that's the trade-off. The trade-off here is that in 10 years on a whole life plan, that's generally our break even. So in 10 years, we put in 500,000 and our equity position is 508. But let's say in 10 years from now, you have that $508,561. That now becomes year 11's new floor, meaning you cannot have anything less than that 508,561. That establishes your new guarantee. So year over year, as you attain those values, you cannot have anything less next year in which you had the year prior. So it's important to remember that. The tax advantages, again, it's funded with post-tax dollars. So we don't care where the money comes from, so we don't source it, but we look at post-tax dollars. The growth on the cash inside the contract grows tax deferred, similar if you held it into a retirement account like a 401k, SEP IRA, IRAs, Roth IRAs. And then the funds are accessed tax-free when structured appropriately. Again, to reiterate, the only time you will pay a tax on the cash value is if you were to give up the life insurance. So if we were to give up the life insurance and forego the policy, you will be taxed on any gains in the contract above your basis. If you do not cancel the policy, we can pull out 90%. That's the magic number. 90% of the cash value tax-free. That reduces the death benefit. And then again, wealth preservation and distribution, how life insurance works, which is how most people know life insurance works, is that it pays out to beneficiaries tax-free, income tax-free, okay? Could be subject to estate tax. However, with the tax reform now, might be a moot point. However, income tax-free, it is paid out lump sum. If there's any legacy issues, we hit on that earlier as well. So if there's people that are important to leave their children or their grandchildren a legacy, it's a great asset to leave them because it is tax-free. Any charitable inclinations, you leave that money, the charity inherits that money or receives that money tax-free. Also, it can help us with that retirement security and providing ongoing lifestyle expenses to a spouse should one of us predecease our spouses. So it is essentially, like we call it, the Swiss Army knife, because it is not just a death benefit. It, again, driving it home, it's liquidity, it's accessibility, it's leverage, all while doing better than lazy money sitting in the bank earning about a half a point right now. So how do we choose the right type of insurance, right? So again, what are your needs? Generally, when we plan for life insurance, it's around three things. It's debt reduction or elimination, and that could be mortgages, any personal debt, lines of credit, business debt, whatever it be. We then look at education planning. If our clients have children, is it important to them to provide monies earmarked for education? And then most importantly is income replacement. When we're sitting down with a family and a couple, the breadwinning spouse should proportionally carry more death benefit than the non-breadwinning spouse should. Even if you have a stay-at-home spouse, there is a value to that individual in that they should have some sort of coverage on them because if they're young children, we need to provide funds that maybe includes daycare costs, childcare, nannying, whatever it be. What are your goals, right? And then what's your budget? That's the biggest thing. Like we said earlier, Taylor and I ran that plan at $50,000. We can scale that number up. We can scale that number down. So it's very proportionate to your needs. We work within a budget. Our ideal clients generally earmark about 5% of their income into those programs, in addition to their other savings, whether it's money in the bank, real estate, retirement savings accounts, and education plans. So again, most people purchase both term and permanent. Okay. However, right now, the lion's share of the industry, and our biggest competition is the internet, similar to doctors and WebMD, but about 1 out of every 4 people buy permanent insurance policies. The industry or the economy is shifting more towards term insurance. However, the projections over time are expected to change up. As we create that awareness and showing people how you're not just buying that death benefit, you can utilize it for different areas. We feel that now that number is going to more than likely flip-flop, in that it's going to be about 1 out of every 8 individuals is going to buy a term policy, and the lion's share will be permanent. We all know that we're going to pass away. We all have a start and an end date. Like I always tell my clients, if you told me when you're going to die, I'd tell you what to buy. But not many people can tell me that. So what we do is we try to use a little bit of both types of insurances to meet their overall needs. What we also talk about is that over time, our clients' needs might diminish. Right now, we might have a larger, the dependents might rely on us for more, be it education planning or retirement planning or whatnot. And over time, that number diminishes. So that's why it's important to get a larger amount of coverage earlier on, and just make sure your plan changes as your situation personally changes. Again, how much life insurance do you need? You can go online. There's calculators that are out there. But what we do is, again, what do you have in place currently, if you have anything at all, whether it's done through your own, whether it's done through any spouse's jobs? What are your goals? And then we take that amount in which, if you were not here, what you want to accomplish, back out what you currently have in place, and we figure out the shortage. And again, when we plan with our clients, there's that ideal number, and then there's doing nothing. What we don't want it to do is become cost prohibitive. We don't want it to create a plan for a client of ours, and at the end of the day, them constantly hesitate and second guess and have buyer's remorse. Did I do the right thing? Am I doing the right planning? I want them, and Taylor wants them. We want to make sure you understand what you're doing, why we're doing it, and how it fits into your overall plan. So we want to make sure that it's affordable, and we never have to answer the phone and apologize to a spouse if something were to happen. So again, our approach is process-driven, not product-driven. So we want to know what's important to you and your family. Where are you today? What are some of the steps you've already taken in the grand scheme of things, in the big picture? Where do you want to be in the future? So, for instance, you hire Taylor and I as your co-pilots, right? We leave port A today. We know where port B is at some point in the future. You can only see things so far off into the horizon. So what we do is we control the things we can see. We don't worry about the things we can't see. We kind of get to them when we kind of cross that bridge. So we work with you in that space. We develop that plan. We make that plan actionable. We implement strategies to get you to where you want to be. Because at the end of the day, financial planning is affording you the options. Nobody has a crystal ball where taxes are going to go. Nobody knows where the market's going to go. Nobody knows if we're going to live a long, healthy life and pass away in natural causes, or, God forbid, get into an accident. I've seen it all in 9 years, unfortunately. So we take a very unique approach. So whether you work with Taylor and myself, or we have the ability or the privilege to sit down and engage in a kind of a second set of eyes, a second opinion, looking at your situation, where we might reassure you that you're doing a great job, or bring some areas to light that maybe haven't been presented to you by other individuals in the past. It's important that you sit down with an individual, have a face-to-face interaction or something over the phone, but don't deal with a 1-800 number. Don't go online to select a quote, put your information in, go to a calculator, talk to a professional. So again, you want to shop for quality. Just with real estate, it's location, location, location. With insurance, it's the 3 C's. It's the company, the contract, and the cost, right? You want to go with a reputable company. You want to go with a company that is highly rated in the financial industry. You want to go with a company that's been around for a while. You want to go with a company that has a great history of paying claims. And in this particular space, when it comes to cost, cheaper is not always better. We always joke around I always joke around my clients and say there's two areas you never want to go cheap. It's insurances and parachutes. If you're going to go skydiving, you're not going to go cheap on a parachute. I can guarantee you that. So shop for quality. Work with a company that'll be there when you need them. Northwestern's been around for 160 plus years. Work with somebody you like and trust. You might not like Taylor and I, and that's okay. But work with somebody that you like and trust. Have somebody that will answer the phone in both the good times and the bad times. So I guess that was it. Wanted to keep it to about, like we talked with Brandon, about 40, 45 minutes. So what we want to do now, if it's all right, if we can open up, I guess, those questions, Brandon, I guess that's what we're going to do now. If some people have some questions.
Yeah. So if anybody has questions, go ahead and throw them in the chat here. I actually have a couple questions to kind of kick this off. So
Okay.
my first question would be, a lot of financial advisors say term life is the way that you want to go because it's cheap, it's straightforward. So why would you suggest permanent or whole life, or maybe those are the same thing? Why would you suggest those over term life, and does it vary situation to situation?
Yeah, so it definitely varies by situation, right? Because you can line up 100 advisors and you'll get 200 answers. That's just kind of how it works. So when we deal with people, you got to have conviction, number one. So it sounds corny, but when I go and I buy a car, I make sure the individual that's sitting across the desk from me, selling me a car, is driving me what he or she is selling. Because if you don't drive what you're recommending to me and my family, you don't have conviction behind what you're selling, I'm not going to work with you. So the way I personally own my planning and my insurance program, me and my wife, is I recommend that to my clients in the same way, not to the same capacity, not to the same percentage breakouts, but I recommend a little bit of both. There are clients that just want term insurance because, again, that's how the industry is going. And the whole idea of buy term and invest the difference is around. I'm sure, Brandon, you've heard, and other folks on the call have heard as well. But when dealing with insurance, you want to sit down and be educated. And at the end of the day, my job and Taylor's job is to educate you on why we think it makes sense to maybe own one over the other or a little bit of both. And if you appreciate that and you can reiterate that back to us why it fits and see the value of it, then it's generally not a question at hand. Does that kind of answer that question?
Yeah, it does. And my follow-up question to that is, we have a lot of clients that have whole life insurance, and they're using what they're all calling that infinite banking concept to invest in their real estate portfolios and grow their real estate portfolios. I'm wondering if you guys can talk a little bit about that. We don't have to get into the weeds because I know it can get super complicated, but I'm sure everybody on this call would be curious as to how they can approach their financial advisors or even you guys with such questions. So if you guys could summarize how whole life insurance can help grow a real estate portfolio, or what that infinite banking concept is, I think that'd be helpful too. Yeah.
So again, it's all about having it's liquidity and accessibility, right? So with real estate opportunities, if you find something, now again, it's with whole life, it's the more you put in, the more you get out, right? So if you're going to put in $50,000, the numbers are going to look good. If you put $100,000, they're going to look twice as good. If you put $25,000, they're going to look half as good. However, over time, as that cash, and generally this is not a bucket of money where we recommend our clients put money in and say, okay, 10 years, you're going to tap into it for whatever it be. It's that kind of mid to long-term bucket, that 15-year play on the cash. Because what happens is you have access to that cash. You call me up. I had a client of mine last year. He wanted to help his son with a property in California with a down payment on a home. He pulled $250,000 tax-free out of his cash value, and we wired it to his bank account. And it was very liquid, very accessible. And now if he wants to pay himself back, he can pay himself back. If he doesn't, then it just reduces the death benefit. But it gives you that leverage, if you will. So instead of having multiple properties and and, leveraging one against the other and so on and so forth. Keep doing what you're doing. And if the opportunity presents itself where there might be another piece of property that hit the market and you don't want to take a loan or you're leveraged too much already, pull the money out of this policy completely tax-free, and it gives you that means of cash that's actually doing better than a bank account, and affords you that, again, liquidity.
I think if I could add to that too, just diversification in general. So a lot of the clients we work with that are in the real estate market, I think they also understand that they shouldn't have all their dollars there. Maybe they're good at doing it, the majority of that market, but having some sort of asset that works a little dissimilar. So again, going back to the things we had talked about before with that guaranteed growth, at least something within your overall portfolio is constantly growing on an every year basis. And if you see an opportunity from a real estate perspective, take that money out, very liquid, tax-free, and what you can also use it for is down market. So housing market's down, a lot of us know here it's a good time to buy if you're an investor. And so what you can do is utilize that as leverage to pull money out and purchase new property. And if you sell it or generate income through rent, you can just replenish those dollars, or like Felix has said, if you pass away, they'll deduct it from the life insurance part.
Awesome. Thanks, guys. So if you guys can open up that Q&A window, We've got, it looks like 6 questions queued up. And again, for all the attendees, Felix and Taylor are just going to kind of run through some of these. They might not get to your question depending on the contents of it. And if they don't, then feel free to either email us at contact@realestateCPA, or you can email Felix. I've pasted his email in the webinar chat.
All right. So I want to run down them real quick because so far we got 6 of them.
The camera fell a little bit.
Oh, all right. There's my head. Okay, there we go. Oh, there we go. All right, so we're going to go one first from Stephen O'Leary. It says, I see the benefit of permanent for the tax avoidance, carry Guardian Whole Life Plan because of this with a term component. Most people here are investors. I'm sure they have looked into them. Can you speak to the common objections you hear? First, insurance brokers love to sell it because the commissions are so large. I've heard first full year of payments. Lots of people say it destroys their returns. Second, life insurance should only be term. You should invest the additional money in index funds and the returns will exceed whole life appreciation and trump those tax benefits. And 3, a majority of people default on whole life and the plans are not typically paid out. So with the first one, the common objectives are, right? So they are heavily front load. I can tell you, I'm going to pull this up. It might be helpful for everybody to see that illustration again here and kind of show you how Taylor and I design our plans. So I can tell you that I'm licensed with 40 insurance companies. Those other carriers out there outside of Northwestern Mutual will pay me more actually to sell their products than Northwestern. Mm-hmm. So Northwestern, my first year commission on a policy is 55%. If I were to go to Prudential or an American General or Banner or somebody like that, they're going to pay me upwards of 90, 95%. If that goes to show you anything, I'm putting my client's interest ahead of mine. I own a lot of all I own is Northwestern. My whole family owns Northwestern. The only time I will go outside is if a client is looking for something in which Northwestern doesn't afford, or if they can't qualify for Northwestern due to some medical instances. So the way this plan here is designed for everybody is that $50,000 premium, again, is overfunded. So the concept there is overfunding. Is Taylor and I are comped only on 50% of this. So we're comped on $25,000 commission, or, well, it's not a commission, that's premium. That extra $25,000 that's additional, that's your money. So that goes right into the cash value. So we're not comped on that money. So we're designing it, not putting dollars in our pockets, doing what's in the best interest of our clients. The second objection is by terming invested difference. I hit on that earlier with that concept. There's carriers out there like Primerica, and literally, if you read the contract on Primerica, it says we are a by term invested difference. And I would say you potentially could do better, but not with these dollars. So when we design plans for our clients, we're giving you buckets. We go with the bucket idea, whether it's with market volatility, tax diversification, whatever it be. We don't allocate all of our clients' funds into one particular area or not. So yeah, the index funds make sense with a piece of your money. These dollars over here serve this purpose. So I can get around that objection rather easily, having done this for so long, because these dollars are not, they're an apple to an orange. With the third one, a majority of people default on whole life and the plans are normally not paid out. I would say that with us, if they are defaulted, you get early warnings and you get things like that. Most of my clients don't default their life insurance policies. Maybe there's options in which people aren't aware of, in which you have a provision in your policy which is called going paid up. So if you can't afford the premiums anymore, you can, instead of cashing it out or defaulting, or essentially defaulting the contract, you can go paid up, and that provision there will, the death benefit will adjust to the amount of premiums paid into the policy, and therefore you'll still own the policy. The cash will still grow, the death benefits still grow, but there will be a reduction initially in that death benefit. So hopefully, Steve, that answers those questions. I want to move on to next. I want to have Taylor answer this one from Tyson Miller.
Tyson Miller, with the policy presented, what is the start of costs in the form of premium, and how far out you reach break-even point and start to grow? So, as back to Felix had said, it's all scalable. We showed 50,000. We got clients, that are doing $100 a month. It's really all scalable there. So the startup cost is really just kind of getting and going, depending on the amount of insurance that you want or the amount they want to contribute to a program like this. In terms of break even and start to grow, it starts to grow immediately. Break even may just be different depending on if you're doing what we call all base and not overfunded, or depending on obviously how much you're putting. So someone putting 50 grand a year overfunding it, like we saw, may break even slightly earlier than someone doing, $1,000 a month. So really, again, it's all scalable. We go through that with our clients. It's not a magic wand here. It's really just kind of coming together on what's the right amount for them, what makes sense in their overall portfolio.
Yeah, I would, to add to that one real quick, would be in this particular case, again, if everybody can see it here. So column number 6 here is your cumulative outlay, right? So it's $50,000 every year. And if you look at it, I first point out the cash value increase. So what is that cash value increasing year over year? And your break even from a gain standpoint year over year happens in year 5, meaning in year 5, you're going to pay in $50,000. And that particular year, your cash value is projected to increase $50,357. So that's essentially, you pay Northwestern Mutual 50 grand. In return, they're increasing your equity position by $50,357. However, the cumulative break even happens between years 9 and 10, where you put in $450 in year 9 and you walk away at $443 if you decided to cash out. In year number 10, it's $508, you put in $500, and therefore every year thereafter, the gains are larger. So essentially, the costs are incurred in this particular design in the first 5 years, which is generally where those costs are incurred, similar to a mortgage with the interest payments and things like that when you pay on a monthly basis. So hopefully that worked. Next question from an anonymous is, what is a fiduciary? Fiduciary is acting in the best interest of your client at all times. So I do carry the CFP designation, the Certified Financial Planning designation. I am held to the highest fiduciary standard in the industry, which about 8 to 10% of the total financial services industry has. So when you're dealing with a advisor who says he or she is an advisor, but really all they are is a money manager and not a planner, I would say it's important to deal with somebody that is a fiduciary, making sure that they're worried about doing what's in your family's interest over theirs. Ask them what their commissions are. I have no problem with telling my clients how much money I will make when I sell a product. I am a big believer of full disclosure and transparency. And when getting off on the right foot with my clients, it leads to a better relationship long term. Next question comes, is there a minimum cash value that must be built up prior to borrowing against? Also, can you borrow against the full cash value or only a percentage? So there is no minimum, okay? You can put money in, and in year 2, you can take money out. So in this particular case, again, in year 2, you put in 100 grand and your cash value is 68,518. You can call Taylor and I up and take 50 grand out if you want. There's no time period. There's no age limit like there would be in a retirement account, such as 59 and a half. There's no penalties to take it out early, nothing like that. When you borrow, you're borrowing up to, the magic number really is 92%, but not to get too technical. We round it down to 90%, makes math a little bit easier when looking at numbers. But that's with keeping the insurance policy intact, 90% is the max in which you can take out tax-free. If you take anything out over that, we kind of jeopardize the death benefit. From Michael Ryan, explain the cost basis on cash value, and I guess on surrender value. So I'm going to go with, so cost basis essentially is, and I'm not sure if maybe we're referencing this right here, but cost basis is your total contributions, right? So your cost basis in this particular plan, 50,000 a year times 22, that's 1.1. That's your basis. It is different from your cash surrender value, okay? So when you take money out, you have access, you take your basis out first, tax-free. No problem, no loan, no borrowing, no nothing. You take your basis out tax-free. It's like, okay, I put in 1.1 million over 22 years. When I'm 70 years old, I want to pull out that 1.1 million. You take it, no problems, no questions asked. But what we see is clients generally don't do that. What clients generally do is they take dribs and drabs. So what they do is to give them flexibility, the way we illustrated it here, is we're going to take out 120 a year up to your basis first. So for the first $1.1 million you're taking out, it is a complete return of basis. So it is a tax-free distribution, no loans, no nothing. After you eclipse that 1.1 million, that money above, so in this particular case, total was 1.8 million. That 1.8 million less the 1.1, we now took out a credit almost about $820,000 above our basis. So we took out more money than what we put in over that 15, 16-year period. So now that 820 is the amount of money that we actually borrowed against the death benefit, okay? So we borrowed against that death benefit. And the unique thing about this policy is even though you're taking money out of the cash, you're still earning a dividend, and that dividend is still being reinvested into the insurance and into the cash. So after taking out 1.8, 1.9 million, we're still left with an extra 2 million plus on the side and a death benefit of 2.5. So they're a couple separate pieces, the cost basis versus the cash value and surrender value. Next question. Do you pay interest on the loans? And if so, does the interest go to Northwestern or the individual similar to a 401k? So when you take out the cash value and you borrow, you essentially collateralize your policy against Northwestern. So Northwestern actually loans you the money from their general account. And that interest rate you can do right now, there's a variable rate or a fixed rate. The variable rate is around 5.5. And then the fixed rate is at 8%. Now, the unique thing about when you borrow your money, there's two dividend interest rates that you get, or crediting interest rates I should get. So you get a dividend on unborrowed money. So that's the money that's in your policy. And that is the current dividend of 4.9. And then you get a dividend on the money in which you borrow, which is rather unique. And right now, that dividend in which you borrow is in that 7 to 7.4% range. So Northwestern is giving you a dividend on the money in which you're borrowing from them, giving you a spread of about 0.6 or 60 basis points, in which that's the amount of interest that you're paying back. So the net cost to borrow is between, I would say, a half a point to a point. But it's not like a 401k where you're borrowing from yourself and you're paying yourself back with that interest. You're actually taking the money out, you're collateralizing your policy to Northwestern, and then that interest goes back to them at the rate of a net, maybe half a point to 1 point. Next question we got here is from Matt Sanford. Have you read Becoming Your Own Banker by Nelson Nash? Do you guys follow the infinite banking concept? Actually, I have not, so that's a quick answer. So, but I can put that. I'm hopping on a plane on Monday, so maybe I'll go ahead and order that off Amazon. Let's see the next one. If I have an existing term life policy, can I convert to permanent? I would say the answer is it depends. You want to look at your contract term. Most carriers do afford clients to convert their term over to a permanent policy, but it goes back to the company. You want to go with a reputable company. There are certain companies in which I will only sell term insurance to my clients. I will not, for the life of me, sell them a whole life policy or a universal policy or anything like that. So it really depends upon the type or the company in which you're with. So if you want to reach on out to Taylor and I separately, you have our information from Brandon, you can do so, and we can take a look into that for you. All right, let's see. So Steve O'Leary again. Great answers. Thank you for the transparency. Is it possible to transfer current Guardian policy to Northwestern, and would it make sense from a return perspective? So with whole life policies, similar to real estate, where you can do tax-free exchanges. In the insurance industry, it's called a 1035 exchange, in which you can take the cash value from one whole life policy and dump it into another whole life policy with another company. So it's a tax-free transfer. The caveat is that you have to qualify for the new policy with the carrier. So if you were to leave Guardian and come over here at Northwestern, we would run the numbers. We would see what your current cash value policy, the current cash value is in the policy, and we would run a proposal similar to this that we're showing you right here. And what that will do is that will go directly into the cash, and that will give us what your premium looks like now as well. So if it makes sense, we can certainly talk offline about it, but it is something where you're able to take tax-free dollars, even if your cash value is larger than your basis, and put it over into another policy. Next one.
So real quick, we got time for one more question.
All right. Let's see. Let's go. We'll just keep it going in the same order. That's what I've been doing. So in the example where you took out $50K from the cash value out of the 68, are you expected to repay the premium over some point in time period or never pay it back? So if you structure the accessing the cash value out as a loan, as not a return of your basis, but as a loan, you can pay that back up to a period over 10 years. So if a client of mine needs to tap into it and they want to structure it as a loan, we have a loan calculator where I say, okay, what do you want to do? You want to pay back a certain amount of money per month? Do you want to pay it over a certain duration? And then we run that calculator, and then we set up a repayment plan. If you're just surrendering or taking money out as a return of your basis, you're not obligated to pay anything back. So I think that wraps us up there, Brandon.
Yeah, that wraps it up. Thanks everybody for attending. I've posted Felix's contact information. You can also contact Taylor through Felix's email. So check that out in the chat there. I know that we have 2 more open questions, and I'm sure some other people have questions as well. So feel free to either email us at contact@therealestateCPA, or just go ahead and email Felix at felix.tuccillo@nm.com. Thanks everybody for attending. Thanks Felix, Taylor for the presentation. It was awesome.
Thanks, guys.
The Q&A was great as well. We really appreciate it.
Cool. Thanks a lot, everybody. Take care.